Ever wondered what propels a global tech and entertainment giant through such a rapidly shifting landscape? Today, we're taking a deep dive into Sony Group's first quarter FY 2025 financial results. We're pulling back the curtain on some, well, frankly, incredible wins and a few strategic moves that are truly redefining their future.
Yeah, and our mission here really is to distill these official reports, their earnings announcement, the financial summary, into the most critical insights for you, our listeners,
Yeah.
especially for those of you already tracking Sony's trajectory. We want to cut through the noise, reveal the strategy behind the numbers.
Okay, let's unpack this. And wow, what a quarter it was. Sony's consolidated Q1 FY 2025 performance was really outstanding. Sales from continuing operations climbed 2% year on year to, what was it, JPY 2,621.6 billion, a huge number. But here's the real headline. Operating income rocketed, a significant 36% jump to JPY 340 billion.
Yeah.
That's a new record high for a first
It
quarter.
really is.
And net income also saw a healthy increase, 23% to JPY 259 billion. What's your immediate reaction to a jump like that, 36%?
Well, it's more than just a big number, right? It
Yeah.
signals incredible underlying strength, especially given the global economic climate. And what's particularly striking to me is that while their sales forecast for the full year remains steady, JPY 11,700 billion, Sony has actually raised their operating income forecast by 4%, up to JPY 1,330 billion.
Right.
And they also bumped up their net income forecast by 4% to JPY 970 billion, and operating cash flow, too, up 2% to JPY 470 billion. So this isn't just one good quarter flashing in the pan. It's showing real confidence for the whole fiscal year.
So for you, our listener, this tells us a story of, well, consistent growth, robust financial health, and a company that's not just surviving these global complexities, but actually seems to be thriving. It points to a well-managed machine delivering above expectations.
Absolutely. However, even the most robust companies face headwinds. And Sony gave a pretty transparent update on the estimated impact of those additional U.S. tariffs. They anticipate an impact on operating income for FY 2025 of around JPY 70 billion. But interestingly, this is actually a JPY 30 billion decrease from their previous forecast, based on the tariff rates announced back on August 1st.
Huh. Okay, so that initial JPY 70 billion sounds significant, sure, but the reduction, that suggests their mitigation efforts are actually working.
Seems like it.
They mentioned they've nearly completed diversifying production locations for their main products, and all planned measures should wrap up by the end of the first fiscal half. I mean, that's an immense logistical undertaking for a company Sony's size.
It truly is. And this raises an important question, doesn't it? Like, what does it take for a global giant to adapt so rapidly to these kinds of unpredictable changes? Sony's approach seems to be carefully assessing the impact based on multiple scenarios, acknowledging it's all quite fluid. Their proactiveness in shifting production, that's a clear testament to their risk management strategy.
All right, let's dive into the individual segments then, because this is really where we see the engines of Sony's growth and, how they're strategically rebalancing things. Let's kick off with Game and Network Services, GN&S. This segment, it truly outperformed expectations.
Oh, yeah.
Sales jumped 8% year on year to JPY 936.5 billion, mostly driven by third-party software sales, it seems. And get this, operating income surged approximately 2.3 times to JPY 148 billion, setting a new quarterly record for the segment.
That performance is absolutely linked to deeper user engagement.
Right.
Look at the numbers. Monthly active users, MAUs, across PlayStation platforms, up 6% to 123 million accounts in June.
Wow.
And total playtime for the quarter also up by 6%. What's particularly notable, though, is that content and service revenue is expected to grow roughly 50%. This is on a U.S. dollar basis this fiscal year, compared way back to FY March 2019.
50%.
Yes, significantly outpacing that MAU growth.
Yeah.
So it's not just about more users, it's about deeper monetization.
Right.
Getting more revenue per user. It really signals Sony's successful pivot towards that sticky, recurring revenue model, which is frankly crucial for long-term stability in the volatile gaming market.
And their content strategy is clearly clicking. Live service games, MLB The Show, Destiny 2, and of course the incredibly popular Helldivers 2. They contributed over 40% of their first-party software revenue this quarter alone.
That's huge.
Plus, they've got big single-player AAA titles. Their blockbuster games like Ghost V8 coming in October, and Death Stranding 2, which launched in June, already hit a Metacritic score of 90.
Very strong slate.
Yeah.
And a really telling strategic move here was the decision to postpone Marathon's release. Sony stated pretty clearly this was to improve quality based on community feedback. They want to deepen the gameplay, elevate the narrative immersion.
Which players generally appreciate, right?
Yeah,
Better late than buggy.
exactly. So while it's still anticipated within this fiscal year, it's not like a hard commitment. It shows they're prioritizing player experience and quality over just hitting a date. Smart, long-term play. And they also touched on the ongoing shift in Bungie's governance. Moving towards greater integration with PlayStation Studios, it's like an evolution of their internal structure happening gradually.
Okay, so from gaming's explosive growth, let's shift focus. Another area where Sony is hitting all the right notes, their music segment. Sales here increased 5% year-on-year to JPY 465.3 billion. Operating income up 8% to JPY 92.8 billion. Solid numbers.
Yeah, and the primary drivers there. Higher revenue from streaming services mostly. Recorded music was up 7%, music publishing up 8% again on a US dollar basis, plus a boost from a mobile game. Their market leadership is, frankly, quite evident. Sony Music Entertainment owned or distributed labels claimed a massive 42% of weekly top 10 global albums on Spotify.
42%?
Yeah, and Bad Bunny's new release held the #1 spot for 6 straight weeks. Their continued commitment to acquiring music catalogs. That's a really savvy move. These assets are proving increasingly valuable for long-term revenue and, well, monetization opportunities. And you can't talk music without mentioning visual media and platform within that segment. Demon Slayer, Kimetsu no Yaiba, the movie Infinity Castle. Yeah. Phenomenal success in Japan. Huge. JPY 17.6 billion box office, 12.55 million attendees as of early August. And with a global release planned with Crunchyroll and Sony Pictures, those numbers are just going to climb higher.
Definitely one to watch globally. Okay, moving to the pictures segment. Here, sales decreased 3% to JPY 327.1 billion, but operating income significantly increased, up 65% to JPY 18.7 billion.
Ah, okay, so that needs a bit of context.
Exactly. On a US dollar basis, sales were actually up 4%, and operating income was up a remarkable 76%, mostly due to higher series deliveries in television productions.
Speaking of TV, The Last of Us Season 2 got several Emmy nominations. Already renewed for a 3rd season. Fantastic news for fans.
And on the film side, 28 Later crossed $150 million globally, and K-pop Demon Hunters became the most-watched Netflix original animated film. So they're hitting different marks across various platforms.
For sure. And a key takeaway here, I think, is their strategic partnership with Bandai Namco, announced back on July 24th. This collaboration, it aims to co-create new IP, work together on video production, distribution, merchandising, especially in anime and manga,
Interesting.
and strengthen marketing through data sharing. Plus, create new kondo, a Japanese term for sort of deep, emotional, experiential entertainment, by combining Bandai Namco's venue knowledge with Sony's tech.
So that really underscores Sony's broader push into immersive, multi-platform experiences beyond just selling a game or a movie ticket.
Precisely.
Now, shifting gears slightly, Entertainment Technology and Services, or ETNS, this is more of a mixed bag. Sales here decreased 11% to JPY 534.3 billion, and operating income decreased 33% to JPY 43.1 billion.
Yeah.
Primarily due to lower TV unit sales and foreign exchange impact. So some headwinds here for sure.
Indeed. The market conditions for TVs, they faced more aggressive competitor pricing than they perhaps anticipated. That hit the volume. However, their imaging business, which sits within ETNS, actually performed well. Got a boost from a subsidy program in China.
Ah, okay.
And innovation continues. They showcase that system, linking their spatial reproduction display with the Venice Extension System Mini, basically for new ways of creating content. Showed it at Cingear Expo 2025. Apparently got strong interest from film production folks looking for those cutting-edge tools.
They also had to address a recall risk for the Xperia Mark 7 smartphone, a production process malfunction.
Right.
But they noted countermeasures are completed, and interestingly, they emphasized smartphones remain an extremely important business for Sony, citing the long-term nurturing of telecom tech and its broader applications. So it sounds like a strategic long view, not just about quarterly phone sales.
Yeah, exactly. It's about the underlying technology and maybe where it leads them long-term. Okay, let's move to Imaging and Sensing Solutions, INSS. This is another powerhouse segment for Sony.
Right, the sensors.
Exactly. Sales increased 15% here to JPY 408.2 billion, even with foreign exchange impacts, driven by more mobile phone and digital camera sensor shipments. And operating income, up a strong 48% to JPY 54.3 billion.
Nice. So the smartphone market is gradually recovering, you said?
Yeah, seems to be. And mobile sensor sales grew steadily. That's due to both shipment volume and increases in unit price for the sensors themselves.
Ah, higher value sensors?
Exactly.
Yeah.
Looking ahead, they expect sales to steadily increase from Q2 onwards, specifically because of rising unit prices from larger sized and, well, higher value sensors. Plus, there's growing demand for video generally. That's driving demand for sensors in new video cameras, opening up markets beyond just smartphones.
Okay. Now, one point discussed on the earnings call, the potential impact of a biggest customer. Everyone assumes Apple increasing U.S. procurement from a Korean supplier.
The competitor risk. Sony noted that this was just reported and needs internal debate, but their stance is basically aiming to maintain competitiveness through product quality and innovation.
Standard response, but
Yeah,
crucial.
it's a classic supply chain challenge, right? And they're clearly aware of it and signaling they'll compete hard.
Okay, finally, we absolutely need to discuss the financial services segment, which is now classified as discontinued operations.
Yeah.
Big strategic shift.
Huge. This segment is scheduled for a partial spinoff, listing on September 29th. Slightly more than 80% of the shares are going to Sony Group shareholders as dividends in kind. The final application to the Tokyo Stock Exchange, that's planned for August 8th. So this spinoff, it isn't just some accounting move. It's really sharpening Sony's focus strategically.
Right. By divesting most of its financial arm, Sony Group is essentially doubling down on its entertainment core, aiming to create a more agile, content-centric powerhouse.
Exactly. Now, for the quarter itself, the financial services segment's adjusted net income actually increased JPY 300 million to JPY 23 billion, mostly due to a better loss ratio at Sony Assurance. However, Sony Life's adjusted net income decreased JPY 1 billion to JPY 15.6 billion. That was impacted by rising interest rates and some risk adjustment liability.
But despite that, new business acquisition at Sony Life seems strong.
Yeah, continued strong. Annualized premiums from policies in force increased JPY 16.1 billion to JPY 131.6 billion, especially in corporate insurance sales. And they are strengthening financial foundations too, accelerating bond sales, using reinsurance, all to improve their ESR, that's the economic solvency ratio. It's a key measure of a financial company's stability.
And the numbers look okay there.
Yeah, consolidated ESR at 184%, Sony Life standalone at 163%. It suggests a pretty healthy financial buffer.
Okay. So the full-year forecast for income before income taxes remains JPY 60 billion for financial services. But the adjusted net income forecast was reduced, down 9% to JPY 98 billion. Why was that?
Mostly due to revised long-term interest rate assumptions, they bumped them up from 2.7% to 3.3%, and some additional risk adjustments needed. But nevertheless, they remain fully committed to becoming a financial services group valued by stakeholders as an independently listed company. So it signals a clean separation, a clear path forward for both entities.
Makes sense. So looking at the bigger picture, then,
Yeah.
the overall strategic shift towards entertainment and content creation businesses is, unmistakably clear now.
Absolutely.
These segments now account for, 60% of consolidated revenue? That contributes to increased stability and productivity for Sony?
And it truly underscores how they balance these different types of business to create a pretty resilient portfolio overall. The diversification across gaming, music, pictures, imaging, electronics. It helps the company withstand various economic impacts, gives them multiple growth avenues.
And it really shows their focus, doesn't it? On anticipating changes like the U.S. tariffs and proactively preparing for risks, especially thinking about Q2 onwards. It feels like a dynamic, forward-looking approach.
Very much so. So, to recap everything, Sony delivered a truly record-setting Q1 performance, primarily driven by exceptional results in their entertainment segments, particularly gaming.
Right.
They're proactively managing the impacts of U.S. tariffs and making significant strategic shifts, like spinning off financial services, to really deepen their investments in content creation.
These moves, they paint a picture of a Sony that's not just innovating on products, but actively transforming its whole structure, building a more resilient, content-centric future. So here's thought to leave you with. Given Sony's continuous push into community-based engagement and its increasing reliance on recurring content and service revenue, how might this shape the future of entertainment? Beyond just products, could it truly change the way we interact with our favorite stories and experiences? What stands out to you from this deep dive into Sony's latest quarter?